I made my fortune by seeing what others could not. While markets celebrated strength, I searched for fractures. While economists pointed to growth, I looked for the cracks beneath the surface. In September 1992, I placed a $10 billion bet against the British pound. People called it audacious, reckless, even, but to me, it wasn't gambling, it was reading the signs that were hiding in plain sight. Today, I want to share with you how macro traders like myself spot economic weakness before it becomes obvious to everyone else. This isn't about insider information or secret formulas. It's about understanding what the data is really telling you and having the conviction to act when others won't. By the end of this video, you'll understand the framework I've used throughout my career, a framework that's made billions, but more importantly, one that's helped me navigate some of the most turbulent periods in modern financial history. Let's begin. For those unfamiliar with macro trading, let me explain what we do. Macro traders don't focus on individual companies or stocks. We look at the entire economic landscape: currencies, interest rates, government bonds, commodities. We're trying to understand the forces that move entire economies, not just businesses. I've been called many things throughout my career: a speculator, a currency trader, a hedge fund manager, but at my core, I've always considered myself a student of reflexivity. That's a concept I developed early in my career, the idea that markets don't simply reflect reality, they actively shape it. Perceptions influence fundamentals, and fundamentals influence perceptions in an endless feedback loop. This matters because economic weakness doesn't announce itself with sirens and flashing lights. It whispers, it shows up in small distortions, in policy contradictions, in the gap between what officials say and what the data reveals. The 1992 British pound trade, what became known as breaking the Bank of England, wasn't luck. It was pattern recognition. The UK was trying to maintain an unsustainable currency peg while their economy was screaming for lower interest rates. The signs were everywhere. You just had to know where to look. And that's exactly what I'm going to teach you today: where to look, what to look for, and how to interpret what you find. The first place I look for economic weakness is in policy contradictions. Governments and central banks often find themselves trying to achieve incompatible goals simultaneously. When this happens, something has to break. In 1992, Britain faced exactly this problem. They wanted to stay in the European exchange rate mechanism, a system that kept European currencies within certain bounds. This required keeping the pound strong relative to the Deutsche Mark, but their domestic economy was weak, with rising unemployment and falling home prices. What their economy needed was lower interest rates to stimulate growth. What the currency peg required was higher interest rates to maintain the exchange rate. You cannot have both indefinitely. I watched as British policymakers insisted they would defend the peg at all costs, but I also read their economic data. Inflation was falling, manufacturing was contracting, the housing market was in distress, the fundamentals were screaming one direction while policy was pushing the other. This is what I call a fundamental contradiction. And when you spot one, you ask yourself, which force will win? In this case, political reality would eventually override the theoretical commitment. Politicians facing angry voters rarely sacrifice their economies for abstract currency arrangements. So I began building my position, not recklessly but methodically. What happened next would validate this entire analytical framework. But I'm getting ahead of myself. Most people look at price charts and see randomness. I look at price action and see a conversation between central banks and the market, between optimists and pessimists, between those who believe official statements and those who trust the data. When I'm searching for economic weakness, I pay close attention to what I call reluctant movements. These are price changes that happen despite massive interventions trying to prevent them. In the months before Black Wednesday, September 16th, 199 the Bank of England was spending billions buying pounds to support the currency, and yet the pound kept drifting toward the bottom of its permitted range. Think about that. One of the world's most powerful central banks was actively buying their currency, and it was barely holding steady. That's a signal, a loud one. I also watch for divergences between related markets. If a country's stock market is falling, their bonds are weakening, and their currency is under pressure all at the same time, that's not coincidence. That's the market telling you something fundamental is wrong. During the Asian financial crisis in 1997, I watched these patterns repeat across Thailand, Indonesia, and South Korea. Fixed exchange rates under pressure, capital fleeing, central banks burning through foreign reserves trying to defend the indefensible. The specifics differed, but the pattern was identical. You might wonder how I have the confidence to bet billions on these observations. The answer is that by the time I make the trade, it's no longer a bet, it's a conclusion based on overwhelming evidence. But there's another element that most people miss entirely. Here's where my approach differs from traditional economic analysis. Most economists assume that fundamentals determine prices. End of story. I've learned that prices can also determine fundamentals. Let me explain with a concrete example. When a currency comes under pressure, central banks typically raise interest rates to defend it. Higher rates are supposed to attract capital and support the currency. In theory, this works. But in practice, raising rates during economic weakness creates new problems. Higher rates mean more expensive mortgages, more expensive business loans, reduced consumer spending, slower growth. And if the economy weakens further, the currency becomes less attractive, requiring even higher rates, which weakens the economy more. You see the vicious cycle. This is reflexivity in action. The defensive measure intended to solve the problem actually accelerates it. In Britain's case, I knew that if they raised rates to defend the pound, they would deepen their recession. But if they didn't raise rates, the pound would fall anyway. They were trapped. The policy contradiction I mentioned earlier had created a reflexive dynamic that guaranteed failure. Once I understood this mechanism, the question wasn't if the peg would break, but when, and whether I would have the courage to maintain my position through the inevitable volatility. The answer to that second question surprised even me. Identifying economic weakness is one skill. Timing your response is another entirely. I've learned that being too early is often indistinguishable from being wrong. You can have perfect analysis, but if you act before the market is ready to acknowledge reality, you'll lose money and confidence. So how do I time these trades? I look for catalysts, events that force the market to confront what it's been ignoring. This might be an upcoming election, a central bank meeting, a major economic report, or simply the exhaustion of a government's foreign currency reserves. In September 1992, the catalyst was becoming obvious. The Bundesbank, Germany's central bank, made public comments suggesting they wouldn't support other currencies at the expense of their own anti-inflation priorities. The Italian lira had already devalued. The pressure was intensifying. I knew the Bank of England was running out of ammunition. They'd spent billions defending the pound. They'd raised interest rates. They'd made public commitments. But none of it was working. When the fundamentals are unsustainable, the policy contradictions are clear, the reflexive dynamics are accelerating, and the catalyst is approaching. That's when you act decisively. On September 16, 1992, Britain spent billions more trying to defend the pound. They raised interest rates from 10% to 12%, then announced they'd raise them to 15%. The market didn't believe them. Neither did I. That evening, Britain withdrew from the exchange rate mechanism. The pound fell sharply. My fund made over $1 billion in a single day. But here's what most people don't understand about that trade. People remember the billion-dollar profit. They forget that I could have been wrong. No matter how strong your analysis, markets can remain irrational longer than you can remain solvent. I've learned this lesson multiple times throughout my career, sometimes the expensive way. My approach to risk management is simple. I size positions based on my conviction, but I never bet everything on any single outcome. Even with the pound trade, if I had been wrong, the loss would have been significant but not catastrophic. I also stay flexible. I don't marry my positions. If the evidence changes, I change my mind. The market doesn't care about your ego or your narrative. It only cares about reality. During the 1997 Asian crisis, I initially built positions expecting certain currencies to devalue. When some governments implemented effective defenses, I adjusted. When others proved unsustainable, I pressed harder. Flexibility is survival. The worst traders I've known are those who can't admit mistakes. They'd rather lose everything than acknowledge they misread the situation. I've made plenty of mistakes in my career. I just try not to make the same ones twice. This brings me to the most important lessons I've learned. After decades of macro trading, here's what I know. First, economic weakness always reveals itself, but rarely where everyone is looking. Don't just read the headlines. Study the contradictions between policy goals. Watch what markets do despite intervention, not because of it. Second, reflexivity is real. Markets don't just reflect reality, they create it. A currency under pressure creates economic weakness, which puts more pressure on the currency. A stock bubble creates wealth, which fuels more buying, which inflates the bubble. Understanding these feedback loops is essential. Third, conviction comes from evidence, not emotion. I've never made a major trade based on a hunch. Every significant position I've taken has been built on layers of analysis, policy contradictions, market signals, reflexive dynamics, and clear catalysts. Fourth, risk management is not optional. Being right about economic weakness doesn't matter if you're forced out of your position before reality catches up with your analysis. Size your positions so you can survive being early. Fifth, humility beats ego every time. The market has humbled me more than once. The traders who survive are those who respect the market's ability to surprise them. What would you do in my situation? If you saw clear signs of economic weakness, policy contradictions mounting, and market signals flashing red, but everyone around you insisted everything was fine, would you have the conviction to act? Would you have the discipline to wait for the right moment? Would you have the humility to admit if you were wrong? These aren't rhetorical questions. They're the real challenges of macro trading. I want to hear your thoughts on this. Have you noticed policy contradictions in today's economic environment? Do you see signs of weakness that others are ignoring? Or do you think this framework misses important factors? Comment below with your analysis. I'm genuinely curious how you apply these principles to current markets. And if you found this valuable, consider sharing it with someone who's trying to understand how macro traders think. Not everyone needs to trade currencies, but everyone benefits from understanding the forces shaping our economic reality. Until next time, keep questioning what you're told, keep studying what others ignore, and remember the biggest opportunities come from seeing what others cannot.